A common misconception is that an all-weather portfolio outperforms under all conditions and scenarios. The fact is, the goal of an all-weather portfolio is not to outperform, but it is to be prepared for any economic condition or calamity, with prepared being the operative word. I mean, as the Led Zeppelin song goes, there will be good times and bad times. And since you can't do anything about it, it's your portfolio and strategy that has to adapt to changing conditions. The all-weather portfolio is the brainchild of Ray Dalio, who runs the world's biggest hedge fund. From an asset allocation perspective, Dalio allocates 30% in stocks, 40% in long-term bonds, 15% in intermediate-term bonds, 7.5% in gold, and another 7.5% in commodities. On the face of it, you and I are not going to like this, with equities carrying a mere 30% weightage in this portfolio. But remember, Mr. Dalio's focus was on protecting his wealth in any economic condition, which led him to formulate a simple framework. You see, according to him, there are only 4 things that can affect the value of assets like stocks, bonds, golds, or commodities. 1, there is inflation, that is an increase in the price of goods and services, which also diminishes the value of currency. 2, there is deflation, which is a decrease in the price of products. Number 3, we have periods of growth when the economy does very well and flourishes. And finally, there can be periods of declining growth or economic recession, as it's generally called. Now, it's this combination of growth and inflation that Ray Dalio calls the 4 economic seasons, and he goes on to define which assets work best for each season. For example, in periods of inflation, one should go for gold and commodities. When the prices are down, then bonds perform the best. During economic expansion, growth stocks are the perfect choice. And in a recessionary environment, one should give preference to bonds. In fact, looking at this matrix, we can now see why Mr. Dalio recommends a higher allocation to bonds as compared to other assets like gold or equities. Point blank, the all-weather portfolio is not made for performance, but it is built to sustain economic surprises. And we can see that in this table here with the all-weather portfolio falling way short of the S&P 500, although it did a lot better than the US inflation rate. However, comparing a portfolio that's loaded with bonds, gold, and commodities with a pure equity index is not an ideal match. But where the all-weather portfolio really wins is on the volatility front. I mean, look at these numbers, 7.8%, 7.1%, 8.8%. So it's an average of about 8% over the long run, which can be a big comfort for anyone who is okay with moderate returns but cherishes a low level of volatility. But all this is in the US, and my loyalty and inquisition will always be towards our tricolor. But with some assumptions which I have listed on the screen, I mapped Mr. Dalio's asset allocation structure to India-based assets. I apportioned 30% to the Nifty 50 TRI, a 40% allocation to 30-year Government of India bonds, a 15% allocation to 10-year GOI bonds, and gold took up the remaining 15%. I also did an annual rebalancing of the portfolio, which is highly recommended by Mr. Dalio and is something he employs for his own all-weather portfolio. So over the last 15 years, this Indianized all-weather portfolio has delivered an annualized return of 9.5%, while surprisingly, the Nifty 50 TRI has delivered just 8.8% over the same time period. In case you're wondering why the Nifty 50 has done worse than the all-weather, then remember this backtesting is from 2007 onwards, and there was a massive crash in equity values in 2008 on account of the global financial crisis, which would have certainly skewed the numbers. But having said this was also the perfect time to test out the efficacy of the all-weather concept, which is expected to protect investors from such economic shocks and surprises. Our Indian all-weather portfolio did that perfectly in 2008 and 2011 when the Nifty was down by 50% and 23%, but our portfolio was at negative 9% in 2008 and positive 4% in 2011. In fact, over multiple time periods, here's how the all-weather portfolio has stacked up per asset category. Firstly, in terms of returns, the portfolio has consistently delivered average returns of 9.5%, while equities and gold have been a lot more volatile. Secondly, there is the volatility part, which is another way of saying how efficiently the portfolio handled economic surprises. And should come as no surprise that the all-weather portfolio has the lowest volatility when compared to equity and gold. So a portfolio that offers 9 to 10% returns at very low levels of volatility can serve as a viable alternative to fixed deposits for at least some set of investors like retirees or people who have critical goals like a child's higher education, etc. Alright, now that I have given some part of the climax in the beginning itself, let's get to the part on how you can develop your own all-weather portfolio. And if you're getting good value from this video, then please do give this video a thumbs up. If you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing tips, strategies and stories that I continually post in the community section. There are three areas one needs to master when constructing an all-weather portfolio. The first is diversification, and getting the asset mix right is the key here. You see, at any given point of time, different asset classes perform differently. But even in the worst of times, it is highly unlikely that all asset classes will be in the negative. The idea here is to build a portfolio such that even if one or two asset classes falter, the others can perform well and the sum is greater than the parts. But having said this, it's important that one diversifies with assets that are negatively or at least have a low correlation to one another. For instance, the table here shows that the performance of equities and gold have been rather tangential over different time periods, which makes gold a solid hedge for equities. So this is something you should do, and that's why Ray Dalio recommends 7.5 to 15% in hedge assets like gold and commodities. But what an investor should not do is to diversify using assets which might seem different, but in reality they tend to move together. As an example, let's take the Nifty 50 and the Nifty Midcap 150 index. Notice the performance of these two indices and how tightly correlated they are over long periods of time, which really doesn't serve our diversification goals. Now let me draw the performance of gold on top of the same graph. Do you see the picture now? There is a significant divergence in the performance of gold versus the two equity indices, which makes it an excellent diversifier. The second pillar of the all-weather strategy is rebalancing, and something you should not ignore. Case in point is our Indian all-weather portfolio that we just examined a while back. Now with rebalancing, I received an annualized return of 9.5%, and without rebalancing, the yearly returns come to 9.3%. Of course, this with or without rebalancing performance varies over different time periods, but since the concept requires us to maintain the original asset allocation, that's what I propose we do here as well. Now, it's possible that many of you have questions on how to rebalance, when to rebalance, what's the taxation impact, etc. And since it's an important area and a slightly biggish topic, I'll take this up in a separate video soon. The third pillar of a successful all-weather portfolio strategy is systematic investing, or SIP as we commonly call it. Now, an SIP is the perfect companion here because the entire thesis behind periodic investing is to chip away the extreme highs and lows and to smoothen returns. So if we do this right, not only does it further reduce volatility in our all-weather portfolio, but it can also improve the post-tax returns without having to do much work around it. Alright, so there are many ways of building an all-weather portfolio. The first approach is DIY, and earlier in the video I explained broadly how a combination of equity, gold and bonds would have delivered us an average and stable return of 9.5% over many years irrespective of the economic condition. In fact, Ray Dalio's all-weather portfolio uses a combination of 5 different ETFs. And if we were to do the same in India, then in my opinion, it will include a 30% allocation to a Nifty 500 or BSE 500 ETF, a 40% allocation to long-term bonds like the ones issued by the Government of India or Bharat bonds which are maturing in 2032 or beyond, a 15% allocation to medium-term bonds that are maturing in the next 4 to 5 years, which can be bought directly from the RBI or as an ETF, a 7.5% allocation to gold for which there are many ETFs available, and finally a 7.5% allocation to commodities for which there aren't many options, but I did read that there is a Nifty commodities ETF, so you might want to check that out. The way I look at it, the combination of these passively managed instruments can help you achieve a peaceful portfolio that gives good risk-adjusted returns and which can survive different economic environments that the country is likely to face over the next few decades. The second all-weather portfolio option is a managed one, and one can look at investing via dynamic asset allocation funds or balance advantage funds as they are commonly called. These funds mix debt, equity, and gold to give an all-weather flavor to wealth creation with good drawdown support and automatic rebalancing. Now, the big daddy of this fund category is the ICICI Prudential Balance Advantage Fund, which offers a moderate risk profile, and its active equity allocation ranges between 30% to 80% depending on market valuations. Now, for the sake of comparison, I looked at the performance data of ICICI BAF and our all-weather portfolio and was surprised to find that our passive bond-centric all-weather portfolio had done better over a 15-year period in terms of returns and volatility. And while the ICICI fund outperformed in 11 of those 15 years, it were those two crisis years of 2008 and 2011 where the all-weather portfolio proved its mettle and made up for all its lost ground, proving something that Warren Buffett has said time and again, that is, never lose money. A third all-weather investing option is the Smallcase platform, and I found a total of 8 offerings there, which were mostly a combination of ETFs, much like our own DIY all-weather portfolio. But what's interesting is that over the last 1 year, our all-weather portfolio has managed to beat most of these small cases. Now, I don't know if this was pure luck or what exactly might have happened, but if anyone has access to any of these small cases, then I'll appreciate if you can analyze the structure and comment back with your own conclusions. The fourth structure all-weather investors can look at are low beta stocks. Now, personally, I am not a fan of this approach because in my head, stocks are inherently more risky and there is no way equities can operate at a volatility of less than 10%. In other words, fitting low beta stocks in an all-weather portfolio is like trying to fit a square peg in a round hole. But anyways, there is a school of thought around it, and low beta stocks, which are also called defensive stocks, are those that don't move as much as the broader market and often act as safe assets that reduce portfolio variability and protect investors during recessions. This sort of behavior is seen in the stock price of companies that operate in sectors like FMCG, pharma, IT services, consumer staples, healthcare, utilities, etc., which have a stable, evergreen demand for their products and services. One can invest in low beta stocks either directly or via Smallcase, or one can buy ETFs or mutual fund units in nifty low volatility fund, which is now being offered by many fund houses. The fifth and final all-weather technique I could find is what is called the barbell strategy. So a lot like a barbell that's used in a gym, it's an investing strategy that involves using two extreme methods of investing. For example, value and growth are traditionally considered to be poles apart, and the barbell theory is that these two opposing forces will counteract each other and the combined portfolio will be able to achieve moderate returns at low volatility. As a concept, I found this pretty interesting, and as a test, I looked at the momentum fund at one end and a value fund at the other. Now, I examined this data over the same 15-year period that we did for all other techniques, and as expected, there were huge yearly variations in what the momentum strategy delivered versus the value strategy. But when I combined these two and did an annual rebalancing on top of it, some interesting results did pop out. So while the returns offered by this barbell approach were higher than our all-weather portfolio, I also noticed an extremely high level of volatility, which is detrimental to our purpose. Of course, I must point out that I've tried just two variables, and there are a lot more factor-based strategies like quality, growth, volatility, alpha, etc. that might offer different results. So I would continue researching around this, and I'll certainly figure out a way of posting the updated results from time to time. So to put this all together, firstly, a good all-weather strategy is built upon multiple diversified assets like equity, gold, debt, etc., which also includes a layer of annual rebalancing and systematic investing. Point 2, and from what I have seen, the all-weather strategy seems to be working in the Indian scenario and has historically offered a stable 9 to 10% return at a super low volatility. More importantly, our all-weather portfolio has managed to skillfully navigate the tough economic conditions of 2008, 2011 and 2015. Thirdly, and from an implementation perspective, there are a number of ways of building an all-weather portfolio ranging from a DIY mix of ETFs and mutual funds, investing via a balance advantage fund, investing via small case or low beta stocks, or even trying out some exotic strategies like the barbell approach that we examined in the video. The point is, an all-weather portfolio need not be a risk profile choice or something that only a retiree can look at. In my opinion, this portfolio can serve as a useful and reliable anchor to anyone, especially to the more aggressive part of one's portfolio. Personally, I am yet to try something like this in a very organized manner, but after researching for this video and knowing what to expect, I will certainly want to take some active steps and reorganize the non-equity part of my portfolio around the all-weather principles. As I've always said, investing is and will always be an evolutionary exercise, and I sincerely hope you found this video useful. Once again, thank you for your time. Do like, do share this video, and I look forward to reading your comments. Until then.